Hey, yo, what's going on, guys? This is your boy, Will Fresco, and in today's video, we will be going over call debit spreads and put debit spreads. Now, real quick, in a nutshell, what is a call or a put debit spread? It is when you buy and sell the same security at the same time, same expiration, and all that good stuff. It is done in one transaction. I'll walk you guys through it. I'll show you guys exactly how to do it so like that you guys set it up correctly. Now, why would you go with a spread instead of a naked option? You know what I'm saying? Like, just why not just do a naked call or a naked put? Less risk. It is cheaper. It is called the cheap man's option plays. All right. So it is called the cheap man's option plays for a reason. All right. The premium is way lower. I will show you. For example, if you want to play Tesla, let's say you want to buy a put or a call on Tesla. If you don't have an extra 3-4 grand laying around to put it on a call, then you know what, you're straight out of luck. You can't make a play on Tesla. You know what I mean? But with the debit spreads, they actually give you an advantage as to, it makes it more affordable. I guess that's what I'm trying to say. It makes it more affordable. The reason it's more affordable is because your premium is actually the difference between the call or the put that you're selling and the call or put that you're buying. All right. So your premium is way smaller. It is not a $2,800 premium. It's more like a $28 premium. All right. And like I said, I'm going to show you guys, I'm going to give you guys some demonstrations. And so like that, you guys could kind of like understand what I'm saying. Real quick, before we get to the computer, before we get on Robinhood, I am using Robinhood because Robinhood tends to make it dummy proof. And it's so pretty. Just admit it. All right. It's pretty. It's a pretty goddamn app. All right. So I'm going to be doing Robinhood. The same thing you could do it on. I use Thinkorswim. And also on WeBull. All right. They all work the same way. You can set them up the same way. But Robinhood puts it in a way that it actually tells you it is a call debit spread. So you know you did it right. All right. So before we go to the computer, real quick, the Discord, we are increasing pretty nicely. All right. Pretty faster than I thought. All right. But the first 500 people on the Discord will be free. After that, it'll be $10 a month. Maintenance fee for the bots and all that good stuff. All right. So I'll have a link to the Discord down in the description. So you guys make sure to click that and come join the Discord. All right. We just talk stocks and options and all that good stuff. So when we trading during the day, we actually have something to do. We chatting with each other. It's actually pretty fun. All right. And there's a whole lot of useful tools and all that good stuff. Everybody's always willing to help and you guys will enjoy it there. All right. Anyway, now that we got that out the way, let's go jump on the computer data. All right. So real quick, first, I want to show you guys how to set up a call debit spread. Then we'll do the put debit spread a little later on. It's going to be the same thing. It's just going to be the opposite. All right. Call and puts are like opposites, right? It's like black and yellow. Those are not opposites at all. Whatever. You know what I mean? All right. So we're using Robinhood on the desktop because it's pretty. All right. It's a pretty goddamn app. I mean, look at it. All right. The SPY ETF. The SPY ETF has been having consistent growth for the past year. No, screw that. For the past 5 years. All right. So this is a very safe ETF to put your money into, especially with this call spread that I'm going to show you. By the way, I am not a financial advisor of any way, shape, or form. This is just my opinions, and I'm just showing you guys a quick strategy. All right. So let's jump right into it. We're going to go to Trade SPY options. Trade SPY options. We're going to click on that. Now, if you notice right here, you do have little plus signs on every option play. You have plus signs, so you can add them to your spread. On mobile, you will have on the top right hand corner, you will have an option that says select. You're going to have to click select in order to be able to select multiple plays for your spread. Now, we're going to start off by selling a call, right? This is going to be call. You're not going to touch this call put right here. You're not going to touch it at all. You're going to leave it on call, and we're going to sell first. Now, let's say we think that SPY will be, you know what? Let's pick an expiration date. How about that, Fresco? Let's go to July, just June 30th, just for the hell of it. SPY is currently trading at $379.70. Now we think that SPY will go up to 381. All right, that's pretty safe, right? That's pretty safe to say. So we're going to sell a call for 381 strike price. That's going to be 1838. All right. Now what you want to do is you want to buy the call that's right below it. When you make a call debit spread, the call that you're selling always has to have a higher strike price than the call that you're buying. All right. That is the key. If you notice, once I pick the call that I'm going to buy over here on Robinhood, at least, it will tell you that it is a call debit spread. All right. That is very important. Make sure that the call that you're buying has a lower price than the call that you're selling. All right. So the sell strike price will be higher than the strike price of the call that you're buying. I hope I didn't confuse nothing. I'll write it on the screen though. But again, I'm going to say it one more time because even though it sounds simple, you might get a little confused. I mean, I did when I first started doing it. Right. So the call that you're selling, the strike price will be higher than the call that you're buying. Right. I like to explain things as if I was 2 years old to myself. Like if you explain something to me, I like being talked to like if I was a 2-year-old because I don't like having any doubts. I don't mean to insult anybody by explaining it this way, but I just want to make sure that you fully understand. All right. All right. So why would you want to do a spread instead of a naked call? Because I could just do a naked call for 381 or the 381 strike price and have unlimited profit potential. You know what I'm saying? Once it hits 381, if it skyrockets to $500 or whatever, then I might make 2,000% profit, right? But what are the chances of that happening? Very slim to none. And you're going to have to put up $1,800. Now, let's just take this out the window real quick, just to show you guys. Let's say that I buy one call. Let's say I buy the 381 call. 1838 times 100 because options is a multiplicative of 100. And I'll put it right here just so you guys can see it visually. It would cost me $1,838 for one contract of SPY at the 381 strike price. Now, the advantages are that, yes, it does have unlimited profit potential, but the downside is that you might lose $1,800. All right, so that the max risk for this is $1,800. The max reward is unlimited. All right, that's one thing. Now, let's go back to where we were. Let's go back. Let's sell our 381 like we were, and let's buy our 380. Now, if you notice, this debit spread is only going to cost us 62 cents per share, which is 62 times 100, which would be $62. It's $62. All right. That doesn't seem like a lot. It's actually pretty cheap. All right. So one contract of this is going to cost us $62. That's a big difference from $1,800. Now the strike price is the same. Anytime that SPY goes above 381, then I hit my I capped my profit. Now, how much is my profit? How do you determine how much your profit will be? You look at the strike prices. The strike price is the difference between the strike prices. That is your profit times 100. So the strike price for the sell is 381. The strike price for the buy is 380. The difference is $1. So $1 times 100 is $100. So our max potential profit is $100. Anytime that the 381 strike price hits, let's say the share price goes up above 381. It doesn't matter if it goes up to 500. The most we can get is $100 out of this contract. And if you subtract the $62, that's $38 profit, right? So it'll cost us $62 to get in, and we hit it, we will make $100. So we make $38 profit. Now, why do people do this? Or why would you even bother? One, like I said, you're not paying $1,800 for a contract that's not going to hit. All right. This is going to be a June expiration. It's a quick $38. You figure it's like 50% profit on this one right here, the one that I'm using, for example. And that's because I have it so close to the strike price. This you could do you could buy 10 of these if you wanted to. Let's say you wanted you were brave. You buy 10 of them. Now that the buy-in price is going to be $620. That's going to be your premium for 10 of them. But your profit is $1,000. You know what I mean? You're going to make $380 profit. And this is a pretty safe bet. You know what I mean? You could put this in there. You could make this play and just leave it sitting in your portfolio. And then you'll just wake up and be like, oh shit, look, I got $1,000. You know what I mean? So you make 380 out of this, and it's not too shabby, right? Now, I'm going to show you guys some examples of like you got to play with it. It's kind of hard to explain. You got to play around with it with the different strike prices and the premiums, because you can actually get it like really low and really quick. And I'm gonna give you a perfect example with GME. Everybody's chasing GME, right? Like, oh my God, GME, I'm gonna be rich. That's what I'm here for. So let's look at GME, and we're gonna do a call debit spread. So we're gonna do expire on Friday, this Friday, March 5th. Just, I'm gonna give you an example because it's gonna be ridiculous. It's gonna be sick. All right, so let's say we think that GME is going to go up. Let's do a call. All right, it's gonna go up to let's go up to 103. Right, it's gonna go up to 103. So we're gonna sell a call for $103 on the $103 strike price. You're gonna sell a call on the $103 strike price. Now you're gonna buy a call right under it, 102. Go 102. Now our cost to get in this, instead of it being $3,400 for a call on GME, it's only $30. That's a huge difference. If you think you have the game that you cannot get into a GME play because you don't have enough money, with the debit spreads, now you can. Your highest profit per contract is going to be, again, the difference between the buy and the sell strike price. So the difference from 103 to 102 is $1. So your maximum profit is going to be $100. Now, mind you, it only costs you $30 to get in this. So the max loss that you can take on this play right here is you lose $30. And that's it, right? Now, if you hit it before by expiration, one other thing about the spreads is that the theta or the time decay does not affect you in one bit on these plays. If anything, it is the opposite, right? The theta, the closer you are to expiration, the higher your profit, if that makes sense. Yes, it's true, right? No theta here. You don't got to worry about time decay. So the closer you are to expiration, the higher your profit. So let's say this contract cost me $30 to get in and it goes above 104. I could close the contract one move. The same way you would sell a contract, so to close, you do the same thing here. You sell this to close it and you collect your profits. Again, this is a $70 come up, which is about a 210% profit, I think. 210, 220, something like that. Like a 220% profit on this play right here, just with $30, and you're able to make $100 out of it. So you make $70 profit. Now, remember, you can buy multiple contracts. You don't have to buy one. Let's say you feel brave. Like, oh my God, you know what? I feel brave. Fresco feels brave. So I want to buy 10 contracts. Now, 10 contracts will cost me $300. And if it goes above 103, then I make $1,000. Again, it's the $1 difference between the 103 and 102 times 100. That's $100. And then it's 10 contracts. So that'll be $1,000. So you're able to go up about 200, 230 or 220%, whatever it is. But this is a 200% come up that you can actually make really, really fast. And all you paid, to be honest, was $30 a contract, right? So you guys get the gist of it, right? All right, so now that we know how to set up a call debit spread, I'm going to show you guys how to set up a put debit spread. Now, on a call debit spread, it's bullish. You think the price is going to go up. On a put debit spread, you are bearish. You think the price is going to go down, right? So right now, we're still on GME. Let's say GME shares are 99.50, and we think the price is going to go down, right? So we're going to sell a put. Now, unlike the call, on the call debit spread, when you set it up, the call that you're selling has a higher strike price than the call that you're buying. On a put, it's the opposite. On the put that you're selling is going to be at a lower strike price than the put that you're buying. And this is what I mean by that. I think that GME is going to go below 98 before Friday, right? So I'm selling a put at the 98 strike price, right? That's the first step. Now we're going to change the sell to buy, and we're going to buy, we could buy the 98.51 or the 99. It doesn't matter which one you buy. The spread could be wide. The only difference you're going to see there is going to be the premium, right? So let's say we're going to buy the 90, let's do 99. So we bought the 99 put and we sold the $98 put. Remember, on a put debit spread, the put that you're selling is going to be a lower strike price than the put that you're buying. On a call debit spread, the call that you're selling is going to be a higher strike price than the call that you're buying, right? So they're the opposite. Right here, I'm saying that I think GME before Friday will go below $98, right? This is what the play is. Now, this premium is going to be $70. The way it works is if it goes below $70, then both of your plays are in the money and you're basically buying and selling it simultaneously. You don't have to do this manually. You just close, you sell to close, and it's done automatically and it just takes your profit. The same way when you sell to close a naked option, a naked call or a naked put, all right? So you close it the same way. But this is how it works, and this is why the premium is lower. It's because you are buying and you are selling the same security with the same expiration, all right? So that's why the premium is so much lower. On this one right here, the premium will be $70 to get in, which is 70 cents times 100, because it's multiplicative of 100, and that'll be $70. And the max that we could make is the difference between the sell and the call, which is $1 times 100 would be 100, all right? So on this put expiring March 30th, which I wouldn't recommend because it's not a lot, but it's still something. You make $30 profit for a minimal premium. You know what I mean? You don't have to put in $3,300. You know what I mean? That's insane for one put. So if this goes below 98 before Friday, then you just made about 45% profit, all right? Which is not bad. Most people don't make 45% profits on regularly, you know what I mean? So this is actually not bad. I want to show you guys some examples of like real leap calls and stuff that you could do, like call debit spreads that are gonna be really, really cheap with a very, very high potential of making money. All right, now that we know how the call debit spread and the put debit spread are set up, I'm gonna show you guys how to use them effectively, all right? I was using the examples there. I'm gonna want to give you guys some like leap call debit spreads. I'm gonna get into myself because they look amazing. Let's do SPY. We're gonna use SPY because for the past 5 years, they have consistent growth, and this is gonna be a leap, so we're gonna put it sometime in the future. For the past 12 months, they've gone up about $172, which is pretty good. So we're going to set up a leap call debit spread. Let's say we're going to go into the future. Now, let's not even go that far. Let's go January. That'll be a good New Year's gift. All right. Right now it's currently at 379. Let's say we think it's going to hit 500 by January. Let's say we think it's going to hit 500 by January, which is not too, it's not exaggerated. Like it actually might do it. All right. So we're going to sell the 500 call. All right. The 500 strike price. We're going to sell that call, and we're going to buy the call right below it. Right? Remember, on a call debit spread, you want to buy the strike price that's lower is going to be your buy, and the strike price that's higher is going to be your sell. On a put debit spread, your sell is going to have a lower strike price than your buy. All right? All right, I got that out of my system. All right, so we sold the 500 strike price for 107, and we're going to buy the one right below it for 95. Let's just say for just for giggles, let's do this one. One thing on the spreads, you can spread this as far as you want. You just got to remember that your sell is going to be your final strike price. You know what I mean? So I could buy a strike price over here for 500, and I could sell the strike price for 500, but I could buy any strike price below here. You know what I mean? The only thing that's going to change is your premium. Your premium is going to be higher. So for this example, I went on the strike price right below it, 495. All right, now this is going to be insane, and this is why I think that this is great for leaps, and this is something that's actually very doable for them by January 21st for SPY. This contract is going to cost me 11 cents a share, so it's going to be $11 for this contract. All right, now the potential profit on this at expiration is the difference between your sell and your buy, which is $5 times 100, which would be $500. All right, now this is where it gets interesting. You're buying this contract for $11, and your potential profit at expiration is $500. So let's say you held this till January 20th or something, and right now SPY is at 505. You sell this, you just made like a 20,000% profit. And why is that? One, because it is so far away, and you see how cheap the premiums are on here, right? You could actually just buy this premium if you want to. But if you buy the premium, let's say for $107, and it goes up from 500 to 515, then data got you already. You know what I mean? So you're not really going to make money like that. You know what I mean? But with this right here, data is not your enemy. Data is actually on your side. So the closer to the expiration, the higher your profit is. I'm going to make it enticing for you guys. Let's continue right here. Let's say we buy 100. Let's buy 10. 10 of these contracts is going to cost $110. The potential profit is $500 times 10. Meaning if SPY hits 500 by January 21st, you just turned $110 into $5,000. You guys get that, right? That's the cap. That's the most you can make. It's not going to go anything above that. If SPY goes to 10,000, it doesn't matter. Your max profit is going to be 5,000 for 10 contracts on this right here for this example. Now let's say that, you know what, you're 100% is going to happen. You got some change in your portfolio. You know what? Let's just do this. Let's make it a lottery play. You buy 100 contracts. 100 contracts is going to cost you $1,100. That's $100 contract on a call debit spread. Well, a leap call debit spread on SPY. A $500 call debit spread on SPY. $1,100 investing, and your potential at expiration is $50,000. You can legit turn $1,100 into $50,000, right? This is why call debit spreads work. And this is why they're so great. A lot of people don't use them. I feel that they're slept on. I think that more people should pay attention to them, because if you use them in the right way like this, then you're able to make some pretty decent money, like really, really, really quick. You know what I'm, not really quick, patience. This one takes patience. If you do a leap called debit spread, it might pay off. You know what I mean? You could invest. You don't got to go crazy. You could go 50. Let's say you go 50. If you go 50, it's going to be $550 to buy in. And your potential profit is $25,000. So you turn $550 into $25,000. Bro, you're like a magician. You know what I mean? You're printing money. And this goes for a lot of securities. You could do, it don't got to be SPY. You could do it. You can experiment. If you want to be safe, you would use SPY because it has consistent growth. Me personally, do I think that SPY will hit $500 before January of 2022, excuse me. Yeah, I honestly think they could. I might mess around and do this play myself. Again, I'm not a financial advisor. This is just my opinion, right? But this is just to show you that there is a very high profit potential using the call debit spreads, and why I think more people should utilize them. All right. So anyway, this video has been long enough. If you guys have any questions, do not hesitate to leave a comment down below. I'll be stalking the comments and stuff. I'll be answering and shit. All right. So don't be shy. Also, if you want to join the Discord, the link is down in the description. And I hope this video helped you guys out. If you guys, like I said, if you guys have any questions, go to the Discord, ask me, put it down in the comments. Leave a like if you enjoyed it. This helped you out a little bit. So anyway, like always, I hope you guys enjoyed the video. And if you're new to the channel and want to stay up to date with my stock tips and videos and all that good stuff, definitely drop a like. And if you really, really enjoyed the video, then subscribe. It's free and it'll put a smile on my face. All right. So anyway, like always, I hope you guys enjoyed it, and I will catch you guys on the next one. All right. Peace.